Smooth 98.1, love music, love life. This is a Business Express. It's Zibby here, and it's all about business, money, and the economy. It's an interactive conversation, and would absolutely love to get your thoughts. The WhatsApp number to send your messages to is 0809 4440981. You can also tweet at Smooth981, and we're streaming live on our YouTube channel as well. It's Smooth 981. You can catch the live stream and you can also post a comment on there. Our guest this morning is Charles NJOKU, Portfolio Analyst, FBNQUEST Asset Management. Good morning, Charles, and welcome to Business Express.
Good morning. Thank you for having me.
All right, so we're talking about investment portfolio rebalancing in the second half of this year. Let's start off with Nigerian Stock Exchange, right? Up over 33% so far, this year at least. What have been the triggers behind this performance?
Okay, I think we've had lots of triggers this year as regards the performance of the Nigerian equities market. Starting off from last year, if you recall that the market actually closed at 45.90% year-to-date return, making one of the best or the best performing stock globally, stock market globally. As such, we saw positive sentiment from investors due to fear of missing out. A lot of investors started buying in. As at the first quarter of 2024, we saw lots of stocks like the DANSEM closing as high as 90%, stocks like NJOKU doing as high as over 100%. A lot of these stocks gained rapidly in Q1, gaining at least 33% year-to-date return for the NGS group, for the exchange. As such, since then, we've seen lots of triggers as well, or actually headwinds that now declined the returns we saw. We saw headwinds in the banking names, basically due to the fact that the CBN has announced some recapitalization exercise, and that reform actually triggered a lot of sell-offs in the banking names. We saw some retracing in the year-to-date return of the NGS market. But since then, other factors has caused some sort of increase in the returns in the market. We saw Transcorp Power listing about 750 billion shares. As such, we saw at 214 year-to-date, you're looking at the return of that stock is around 55%. And that, with other factors, has actually triggered the positive sentiments we've seen in the market so far this year, and the return at 3%.
All right, thanks for that, Charles. I'm really curious about this, though. What is it about the banking sector that has just made it the most active sector when it comes to the exchange, really?
Well, for the banking sector, I would say basically is the recapitalization exercise just to meet up with the minimum capital requirements set by the central bank in order to bolster the capital base of banks. Now, as such, we've seen that banks are trying to raise this capital in order to meet these requirements. We've seen banks like Fidelity doing right issue as over 127 billion naira, and one bank has declared about 40 billion naira in terms of right issues. We've seen GTCO listing about $750 million. Several other banks trying to raise capital in order to meet these requirements. And the rally we've been seeing in banking names is basically due to this exercise. And we've seen sell-offs, like I mentioned initially, sell-offs due to fears of shareholder stock actually diluting their shares, diluting in the market. But most recently, we started seeing some positive sentiment as investors now begin to see that these banking names have actually gotten to attractive price level. In fact, they are currently at their 10-year historical price, and also the discounted valuations as well has actually helped these banking names. So that's the volatility we've been seeing in banking stocks at the moment.
So apart from the banking sector, what other sectors are looking, rather attractive?
Well, it will be very important to also look at sectors like industrials. Now, one of the reasons I'm looking at the industrials is due to the administration's plan towards infrastructure, basic amenities, and basically road construction. And we believe that the industrials actually poses great upsides between now to the end of the year. As such, it will be important for investors to actually look at stocks in that line. Stocks like Gangsem, Boasment are actually good stocks. In fact, if you look at their returns here to date, they're actually doing quite high or quite well. Another sector that you might most likely want to look at would be the oil and gas, due to the commencement of refining activities by the Dangote refinery. So we see that there's room for growth there in terms of distribution in the downstream sector. So players in that sector like Total, Eternal, Conoid, um those companies actually are involved in transportation, inclusive of MRS. It will actually bode well for them, that sector. So I believe that aside the banking sectors, the industrials and the oil and gas sectors will be a good buy for investors to look at as well.
All right, we're speaking with Charles NJOKU, portfolio analyst, FBNQuEST Asset Management. And this morning, we're talking about investment portfolio rebalancing in the second half of this year. Let us know your thoughts. If you've got a question, you've got a comment, this is the time. WhatsApp number is 0809 440 981. You can also tweet at smooth981. Charles, let's go back to school a little bit. Can you explain the combination of a dividend yield and capital appreciation?
Okay. For investors that are investing into the stock market, they look at returns basically, and returns can be either via income generation or by capital appreciation, as price appreciation. Now, dividend yield is the income generating sector, the income generating part of an investment. Basically, the dividend declared by these companies divided by their share price, right? So it helps investors to know how much income they can generate aside from the price appreciation of these stocks, right? Now, the other side that you want to look at too is the capital appreciation, where you look at how much this price has done, it has grown over time as regards the market or macroeconomic conditions. The market performance actually affects capital appreciation of stocks. Now, understanding of these two things would actually help an investor position or make informed decision as regards investment. Now, for the dividend yield part in buying stocks that actually pay dividends, you want to look at the fact that for a stocks or for a company that pay dividend, it gives this sign of succor to investors that the risk in investing in that particular company is low. Also, it also gives this notion that you can get income from that. Now, with the income and the low risk, you see investors actually buying into stocks that pay dividends. And also, they also look at stocks that will perform well in the economy, given the macroeconomic conditions that we have. And they want to also observe stocks that will do well when they look at one or two things that are causing the economy, and that is capital appreciation. Now, when we have both, the dividend yield section helps cushion against headwinds in the macroeconomy. When the economy is not doing well, the dividend yield companies you have in your portfolio of stocks would help the return of the stock. Why, when the economy does well, perfectly well, the other side, the capital appreciation part, bodes well for the investor. So those are the two things investors look at in terms of returns and in selecting a particular stock to buy into.
So risk tolerance is definitely something that should be on that checklist.
Yes, definitely. And this tolerance is very important. Now, an investor wants to know what is your investment goal or your objective in investing. Do you want capital appreciation? Do you want income, or do you want capital preservation? Now, if you're able to define this, you now then talk about the risk. Are you risk tolerant, or is your appetite for risk high enough? How much losses can you handle? When an investor has a good knowledge of how much they can actually handle when they lose their money, it tends to help their asset allocation. Whether you want to invest in a risky asset class, or you want to invest in immediate risky investment, an investment that is in between risky and low risk, or you want to invest in low risk investments like the money market instruments, high risk investment includes equities. So those are the things you want to look at. So risk tolerance is actually a good assessment for an investor to look at.
Now, what's your view on rising rates for fixed income and the money market securities?
Well, I would say with the recent surge we've started seeing in inflation to 33.95%, it has actually prompted lots of aggressive interest rate hike. We've seen that the monetary policy committee has tried to rein on this inflation. Now, if you now peg the money market rates to the MPR rates, the monetary policy committee has actually raised rates cumulative of 750 basis points to 26.25 in H1 2024, just to reduce the negative real return and also attract foreign investment portfolio into the country. In addition, we've seen standing deposit facility rates increase by 400 basis points, translating into higher returns on bank deposits at the window, and also subsequently filtered into rates at the primary auctions in terms of the treasury bills we've seen. So going into H2, I would say that three variables would most likely influence the monetary policy interest rate decisions. I believe that there will be a moderation in inflation. However, starting July, for June, I think inflation will still be high, but starting July, I think there'll be a moderation in inflation. Also, another factor to look at is foreign exchange inflows and exchange rate stability. If all of these factors are factored in, and I see a slight moderation in inflation as such, we'll see a hold in the monetary policy committee in subsequent meetings after the raise I believe that they would do for their next meeting in July. Well, subsequent after that, might most likely stay a hold as such that will filter into the market and lead to slight moderation in interest rates in both the fixed income market and the money market as well.
So a higher rate's a headwind for the equities markets.
Yes, actually. Higher rates are actually headwinds for equity markets. When rates are high, you find it very high or very hard for you to get rates at low levels with the bank. So for you that is a customer to the bank, you get loans at a high interest, borrowing cost is high, and also you would not want to spend anyhow just because you want to manage the little you have. So as such, your spending is low. So when we have high borrowing costs and low consumer spending, it actually affects the performance of stock on the bourse. And when the stocks on the bourse are not performing well, it actually you start seeing that reaction in the markets. Low earnings will actually lead to sell-offs in this stock, and as such, to affect the market. But I would say that it is not a good thing to actually time the equity market. I would say it is important for investors to stay invested as we still see positives, upsides in the equities market. Not doing bad at the moment at 33 points, over 33%. So I still believe there are still headwinds in the equities market for investors to take.
All right, let's talk about the federal government saving bonds. Entry point 5,000 naira. What's your view on this?
Hmm. Well, I would say, first, I would like to say that one of the things that drove the government to do that initiative is just so they can attract retail investors, and retail investors can actually invest in long-term government instruments. Before now, traditionally, savings bonds would most likely, you see most like your minimum requirement for traditional bonds, like 50 million, about 50 million naira, so it's quite high. But for savings bond, generally the initiative is just to attract retail investors to participate in that market space to have a feel of what it looks like. And now, aside from that, to draw in retail investors, you also look at the return. Now, the 2-year return is around 60%, over 60%, and the 3-year federal government service bond is over 17%. And now, if you look at that with the traditional 2-year, 3-year bond we have in the bond market, the new issuance of 2027 bond is around 19%. Now, if you look at the secondary market, it's trading below that. So the spread is not far-fetched. It's not too wild. If you look at the spread between the FBN savings bond and that of the traditional bond. So as such, it is a good investment and it is a good initiative on the part of the government, and also a good time for investors that want low investment at low entry prices, and also federal government bonds are actually very safe bonds. So it is a good thing for investors or retail investors to buy into as well.
All right, thanks for that, Charles. In just about 30 seconds, what does a decent portfolio look like?
A decent portfolio, I would say, is a well-diversified portfolio. A portfolio that is well diversified. That is, if you're looking at your asset class, it is diversified well enough. For the equities, you're looking at sectors, across sectors. Are you investing across sectors rather than concentrating on a single sector or two sectors? You are
Mm.
actually spreading your tentacles across the various sectors we have just to cushion your investment against economic shocks, right? Also, if you're looking at the debt instruments, we also want to look at a short-term perspective and long-term perspective. For short-term perspective, even though they provide low returns, but they are less sensitive to interest rate changes. But for long-term debt instruments, they are very sensitive to interest rate changes, but with good, attractive returns. Yeah, that's it basically.
All right. Well, that's all the time that we have for Business Express this morning. Thanks for listening, and special thanks to you, Charles Njoku, for joining us, portfolio analyst, FBNQuEST Asset Management. And I have to say, Charles, I can tell that you absolutely love your job because the huge smile on your face when you're talking about this, it actually is really nice to see.
Definitely, I do. I do love investing
Awesome.
money.
Well, thank you so much for being on the show this morning.
Thank you so much for having me. I really appreciate that.
Thank you. That is it for Business Express, but do stay with us. There's a lot more to come on the Smooth Breakfast.